first, we start off with today's market sell-off. The Dow down 400 points at the lows of the session, having one of its worst sessions of the year, despite the U.S. and China reportedly inching closer to a deal. And it looks like bears are striking back. The S&P 500 still up 11% this year, surging back from December lows, but failing at the key 2,800 level for the fourth time since the market high. So this is one of the few sell-offs we've seen this year. Should you be buying this dip? Is there more pain ahead, Tim?
Well, you got to give the bears some food, Mel. I mean, let's face it. To say this is a worrisome day for me is a total overstatement. I realize, though, if you want to believe that you're selling the fact on a trade deal and you see the market struggling at 2,800, it's easy to say, hey, you know what, maybe this is all we got. If you look at volatility today, you actually had the biggest vol move intraday than you've had since January 4th, really when we didn't think this was going to go a lot higher. My view is people looked at that construction spending number that was out this morning on a week when we've got a ton of macro out this week. We've got the ECB on Thursday in a policy meeting. We've got the Fed on Friday talking about monetary normalization. And I know we've gotten everything we can out of the Fed. I think markets are worried about growth. I think that's what today is. It's Monday. I'm not losing any sleep right now.
Does this give us any sort of belief that trade is either going to be an upside catalyst or a sell the news event?
I think it's a sell. I think today it told you it's a sell the news event, right? It doesn't mean that we have to go all the way down to the lows, but I think we've priced in a lot of good news, right? S&P up 11.5% roughly year to date. We've seen economic data actually declining a bit, coming in the surprises by the Citi Economic Surprise Index. That's now negative, meaning the surprises have been to the downside. So I think the market got ahead of itself a bit. We priced in trade. We priced in the Fed not raising rates anymore this week. And so it's time to take a break. It's probably going to take a little bit of time. We've had 2 months of a rally. It's probably going to take a month or so. Maybe it's sideways action to down to feed the bears. But
the trend is upward, so you're still in your bull suit.
Medium term, still bullish, short term bearish.
Right, spoken from a guy in a bull suit.
Yeah, exactly.
Karen.
Yeah, I mean, I think as much what Brian's saying, I think a lot of it is already priced in. I thought that we came back off of the lows. I mean, that was a pretty big rally off of the lows. I think, I'm long. I do think we'll get a trade deal, but I don't know if you saw my performance on the closing bell.
Yes. Missed
but
that.
what I was saying is the market is pricing in, buy a rumor, sell the news, but it isn't pricing in a hiccup in this deal. And they keep saying we're on track, we're more on track, we're even more on track. It wouldn't be surprising, just seeing how the Trump administration negotiates, if we did see a hiccup in this deal, and the market will be lower than it is now if that happens.
What's a hiccup is something to sign at Mar-a-Lago at the end of March, right? I mean, right. I don't know. I don't know what the market considers a hiccup or a deal or what.
Well, I mean, at this point, I think, obviously a trade deal is being priced in, but the question becomes, is it going to be a good deal or just an okay deal? Quite frankly, it's okay for the market to take a breather. I mean, this has been a V-shaped recovery. It's been a very, very fast recovery over the course of the last 2 months. Yeah, we're up 11.5% year to date, but we're also up 20% off the Christmas Eve lows. And when we look at the different indicators that we watch, nothing is signaling to us that there's a recession until at least the second half of 2020, maybe even 2021, as long as the Fed stays on pause. So, we think the market definitely has plenty of upside from here.
The quandary, though, for a lot of investors is no recession doesn't necessarily mean equity performance.
Right.
I mean, that's what we saw last year, right? It's a very difficult year. No recession.
It does, although if you want to look at where the S&P was going, even into obviously the highs that we hit in September before the market really started to get concerned about the trade deal, it was happening with at least slower spending, slower capex, some expectation that actually the world was slowing down, yet equities were moving higher. I think we haven't entirely recalibrated our expectations on earnings growth, but the reality is I don't think people are expecting earnings growth anywhere near the 7% we started the year. I think that's bullish for the market. But more importantly, I think this is where you go after sectors right now that have continued to defy either what people think are fundamentals, defy logic, or defy basically gravity. In the case of energy, you keep buying it. Look at those numbers you had out of OPEC in terms of production. It looks like OPEC, first of all, those are 4.5-year lows in terms of OPEC production last month. I think it's still the most shorted sector out there. It's not going to be something that necessarily you hang your hat of the market on, but there's places to invest. I also think that the industrials continue to get a reprieve, and I would be buying Europe, which is massively underperformed.
So Tim brought up energy, which I think is a great point, because the dip you want to buy is when oil goes higher, people start worrying about, wait a second, the Fed's got to come back in because we've got inflation, because energy prices are rising, and maybe the economic news isn't that good, and the trade deal isn't as good as we thought. That's the dip you want to buy, not this particular dip. And the reason why is all those things will ultimately get fixed. The Fed will be on the sidelines. The trade deal will get something done there. And OPEC, it's fine to have high oil prices, but at some point they price their customers out of the market and they'll lay off. So I agree. I think you can buy energy here, but nothing else until you get that real negative dip.
Are you buying right here?
I'm not buying right here. Well, S&P puts, that would be the only thing. I like what I own. I think there is some risk if we don't see a deal, but I do think we'll see a deal. The other thing, though, is even if we see inflation, I don't think the Fed's going to do anything. You know, they talked about being patient, which is different than being data dependent. Data dependent is we'll react to the data. Patient, in my view, is we won't react to the data. So I'm not afraid of inflation.
Right. What
So
you do today, Mark?
I like a lot of these software companies that have pulled back. So we saw, Salesforce ahead of earnings pull back. And these software companies in particular, they really help businesses to become more efficient and more profitable. And at this stage of the game, late cycle, that's what businesses want to do. They want to be more efficient. They want to be more profitable. And these software companies, most of them are generating recurring revenues. And there's no revenue better than a recurring revenue.
Are you concerned about their guidance for the first quarter, which is what's taking the stock down?
Yeah, but guidance has been low pretty much across the board. I mean, you look at just about every single company in the S&P 500. I mean, all of guidance has been pretty conservative this quarter.
Mark, are you worried, though, that some of these higher multiple stocks, software companies, have been the ones that have been most in the kind of the target of the market that has been comfortable buying value, frankly? And I think that, to me, is a safer spot.
Yeah, so, I mean, the multiples are high, right? So, but not all companies are valued the same. It's not always about a PE multiple, as an example. There's specific value drivers that can help a company to command a premium multiple, whether it is recurring revenues or stickiness of their customers. Those are all justifications for a higher multiple.
Let me just push back as a value-oriented. So one of the metrics is growth, right? And accelerating growth, or not flat growth, or not declining growth.
The delta on growth.
Right. And so Salesforce, they'll put up great numbers, and the guidance is really good also. But if you don't see an acceleration of growth, it seems to be priced for that. And is it getting too rich?
And let me push back on that. So when we look at companies in general, when a recession hits us, a lot of those companies are going to watch their revenues fall. In my opinion, Salesforce, I mean, that's going to be one of the last expenses a business is going to cut, because it helps them to run the engine of their business. It helps them to be efficient. It helps them to be more profitable. So I think there's an element there that really helps them to get that higher valuation, because their recession or their revenues are essentially, in my opinion, close to being recession-proof.
How much do you want? Sold to you. Sold to you in the short term. I mean, I think these are going to get killed if you have, I'm calling it an inflation scare. I want to be careful that I'm not saying there's going to be massive inflation. I'm saying we get oil going higher. You get a Fed that's going to be worried about inflation, a market that's worried about inflation. High multiple stocks will get killed in that environment.